Good morning, everybody. Good morning to our guests from Europe. Good afternoon to our guests from the Middle East. And good evening to our guests from Asia. My name is Nik Gowing. I am the founder and co-director of the Thinking the Unthinkable project. And I'm pleased to moderate today's global launch of UBP's Investment Outlook 2021, entitled A Brave New World. We want to make this session over the next hour as interactive as possible. In other words, we want to hear from you as well. So I would like to invite all of you to submit any questions you have, any comments you have, using the question box, which is right under the live stream. Please don't hold back. Raise your questions as soon as they come to your mind. First, though, I'd like to invite, for an introduction, Michaël Lok, who is UBP's Group CIO and co-CEO of Asset Management. Michaël.
Thanks a lot, Nick, for the introduction. It's a real pleasure to me to introduce this Digital Investment Outlook 2021. I would like to thank you for your presence and your active participation. The objective is to give you our views and our convictions on the market and the macro environment after this very special year in 2020. Nick, thanks a lot for your interaction with Norman. Norman, the floor is yours.
Thank you, Michael, and thank you everybody for joining. For those of you who have joined either our in-person outlooks of the past or in June, our first digital outlook, a lot of you will know how we like to kick these off is to very briefly take a look back at what we talked about at our last outlook. And our last outlook was held in June, and you'll recall this was a period of great uncertainty. Economies were just re-emerging from lockdown, and we really didn't have a good idea of what the world held looking forward. So when we met with a lot of you during that period, we really wanted to focus on a few things. One, because of the uncertainty, we wanted to focus on quality and growth in the equity space. That quality aspect was going to be key because of the uncertainty about balance sheets. We thought there was going to be interest rate volatility, really two-way, up and down. And so we wanted to look through that two-way volatility and focus on spread compression. That has worked out very nicely over the last few months. A weak dollar was a key story for us back in June, and that has played out nicely. But where we were caught off a little bit was we had expected a bit more volatility, in particular on the US-China side, going into the election. And so as we look over the past 6 months in particular, we think the world has played out very much as we expected. And so what I'd like to do now, as Michael highlighted, is share what we think the year ahead holds for the global economy, for markets, and for investors going forward. And when we speak to investors over the last few months, I think there are a number of questions that have really come forward, which I'd like to try to address today. One is especially with what's happening with the virus, is there the prospect of a relapse in 2021 in terms of economic growth? On the equity front, a question we often get is, with equity valuations where they are near all-time highs, can we still make money in equities? For a lot of our income-oriented investors, the question of how do you make income in a zero or near zero interest rate world is quite key. And then lastly, what should we worry about in this brave new world that we see ahead? So if we kick off, the anchor for a lot of our discussions is always going to be the global economy. And as you can see on slide 6, really where we are, even though the virus has come back, in particular in Europe and the United States, there is a clear distinction between the lockdowns of March of this year and what we're seeing now. You're seeing a much more gradual decline, much more gradual slowdown in the economies. If you like, policymakers have learned from their experience in March. Most importantly, the credit risk, the high spikes in unemployment aren't manifesting this time. And so from that perspective, when we look at the economy, we're seeing stabilization in the growth momentum, but not necessarily the relapse story that we've seen before. And encouragingly, over the last few weeks, these announcements of vaccines, which should be deployed in the United States and Europe as early as mid-December, you can see on the right-hand panel what's waiting for us in 2021 and 2022 is the prospect for a consumer-led rebound as not only would we expect confidence to come back, but also all of this pent-up demand from staying at home, working from home, that has been the case really for the last 6 months. We would expect that to be released into the global economy over the course of the next 12 to 18 months going forward. Another key difference, if we look on slide 7, is what's happening outside of the West. Remember, back in the early part of this year, China led the world into recession, as that's where lockdowns took place first. So in February 2020, China sat in the midst of recession, and that had forced US and Europe into recession as they locked down as well. You look at what's happening now, even though you're getting softness in Europe and the United States, China has not only moved into recovery mode, but they've moved into outright expansion. And so once again, China remains a support for the global economy and a growth driver as we see it going forward. And that's a key difference than what we saw in March. The last piece of the puzzle, and I think quite interesting, as we've seen the economy rebound, we've had conversations with a lot of clients who are concerned. When are interest rates going to come back? Maybe this means that central banks won't be as supportive. But again, one of the key things that happened over the course of the summer was central banks really moved the goalposts in terms of what they're focusing on. No longer are they focused on inflation, but in particular in the US, they become very overt about it and said unemployment is the key to watching in terms of a turn in policy. And when you look at what we call permanently unemployed, so not those laid off temporarily coming back in some of the retail segments, the permanently unemployed numbers look like what we've seen in some of the worst economic recessions ex the global financial crisis going back to the 1970s. So from that perspective, it suggests to us that the Federal Reserve, the European Central Bank in particular, will be on the sidelines and continue to be supportive of the global economy, even though we're moving into this recovery phase going forward. If we look to slide 8, what does this mean for the equity story? A lot of people say, yes, okay, we have recovery, but equities have priced that. And many people point to this high level of PEs in the market as an example of that. And indeed, in the US in particular, but global equities as well, we haven't seen valuations at these levels anytime since the tech bubble of 2000. And that is indeed worrisome. But one of the things we want to focus on is the difference between 2000 and now. If you look back to 2000, you had a situation where valuations were very high and when earnings growth was peaking and rolling over. And indeed, it was the earnings growth rollover that really catalyzed the collapse that we saw in 2001 and 2002. If you look on the right panel of slide 8, we see almost the complete opposite picture taking place in the global economy in 2021. We saw the trough in earnings growth in the second quarter of this year. Earnings have started to rebound in the third quarter. We expect the same in the fourth quarter, probably still negative growth in the fourth quarter. But as we get into 2021, earnings growth should turn positive and accelerate, especially if we get the vaccine deployment accelerating. And so this earnings cycle is the key for investors to focus on, rather than necessarily the valuation cycle from here. And so where are we looking for earnings? On the next slide, one of the things that a lot of people are focused on is this growth value gap that has opened up. And so a lot of these growth stories, technology, healthcare, have done very well. And a lot of people wonder what is going to allow some of these old economy sectors to move. And if you look at what has driven the lag of these old economy sectors, these value sectors in the world economy, in fact, it's been this picture of sales growth. These new economy sectors have been focused on gaining market share, stay at home, etc. That's been giving up share to retailers, etc. So what we should see as the economies open up again, this yellow bar, sales growth, should go from deeply negative to more positive, And indeed, that's what the manufacturing numbers are showing going forward. We should see this inflection. And so for investors, value stocks, which have been shunned for much of 2020, is going to have a role and a cyclical role in portfolios going forward. This is a place where we still want to be selective. There are many deep value stocks that will not recover because of the shifting in the economy that we'll talk about later. And so we want to keep a quality bias to value stocks going forward. Sectors like mining, quality industrials, and even regions like Europe will have opportunities for investors going forward. But that's not to say on slide 10 that these long cycle transformation stories, these secular growth stories that have led the way in 2020 are to be discarded in portfolios. One of the things we want to keep in mind as we're seeing this transition to recovery is that the pandemic itself is one of the great accelerators of these secular growth stories looking forward the next decade. And so a lot of people in 2020 have focused on technology or healthcare themes. We think they continue to remain robust, but they've also accelerated some other secular themes, including things like fintech, domestic China, and what is on the headlines today, climate change and ESG. And in the chart that we've seen going back historically, it's important to keep in mind these secular time horizons. So we've pointed out, if you look at the biotech story against traditional pharma, online retail versus offline retail, we've compared that to, for example, green energy versus traditional energy, and they're following a very similar pattern. There's a bit of volatility across the secular story, but the long secular story remains intact. So we'll want to manage the volatility, but stay aligned with these secular growth stories within portfolios going forward. On slide 11, let's take a pivot and take a look at how fixed income or income-oriented investors should look at 2021. And fortunately or unfortunately for these investors, Europe has shown the way ahead, especially for dollar investors going forward. Essentially what has happened, and we've seen this in the government bond market, which everybody is focusing on, in Europe first, and now in the United States, central banks in both locations are running negative yielding environments adjusting for inflation. What we've seen in Europe, that hasn't been enough to deal with the slow growth plus the heavy debt burden those economies are carrying. If we look at the United States now has the same problem as Europe. And so the prospect that they go not only negative inflation adjusted government yields, but also to negative inflation adjusted corporate yields does lie ahead going forward from here. So a strategy that worked well for investors in 2020, looking through interest rate volatility and taking the extra spread from corporates, we think remains key. But unlike 2019 and 2020 before, we want to be very focused on credit quality, because one of the consequences of 2020 and government action has been to stretch out the default cycle across the credit universe. And so we want to be very selective in credit quality, especially in the US and Europe, but we also want to start stepping outside of the US and Europe and looking for opportunities in emerging markets, and in particular in places like China, where we see a lot of increased carry opportunities plus foreign exchange opportunities to drive total return for income-oriented investors. If we move to slide 11, the foreign exchange story, all right, on slide 12, the foreign exchange story we think is going to be a key part of the total return story for 2020. As we've seen historically, emerging from recessions typically coincides with a weak US dollar. We expect the same to continue in 2021. So another leg down from the bear market we've seen from the peaks in March. And you can see the kinds of gaps that we see emerging between the US dollar in terms of interest rate differential And it's probably most pronounced in the story we see in China. What's very interesting in China in particular, historically, because China has been very much an export-oriented economy, they've been hesitant to allow too much dollar weakness from here. But as they become much more inwardly focused, as they become much more focused on containing inflation, we think the Chinese will have appetite to allow an ongoing strengthening of the renminbi looking forward the next few years. One of these negative inflation pivots, one of the beneficiaries will certainly be the precious metals arena, which we see on slide 13. And in fact, gold, which we talked about in June, has had a very nice run over the course of the summer. But because we haven't seen this pickup in inflation and a further deepening of this negative real yield environment in the United States, gold has really taken a pause over the next 3 months. As we move into 2021 and we get fiscal stimulus moving through the system and inflation starting to pick up again, we think gold will once again get a tailwind and a bid, and we could see 2,200, 2,300 in gold in the new year. Beyond this, we think the precious metal space in places like silver or even things like palladium on the industrial side should not only benefit from reflationary policy, but should also benefit from the greening of the global economy going forward. What do we worry about looking into 2021? If we look at slide 14, really two things I think are worth focusing on. One, once they ended the US-China trade war at the end of 2019, that dynamic seems to have moved to the back burner. However, under the surface, what we are already seeing is that tension exists in terms of how the US reasserts and reshapes the global economy and how China will seek to reshape its position in the global economy. That remains a concern for us as we move forward into a new Biden administration and how they will handle this relationship going forward. But one area that I think is of concern for a lot of people is this prospect of rising inflation going forward. From our perspective, we do think inflation does rise. As you can see here, the trajectory looks very similar to what we've seen in previous cycles, so nothing too troubling in terms of a move in inflation from here. Once we get into, let's say, the mid or late part of 2021, we think that's at a point where the Fed in particular and the ECB will have to lay down its cards and see how much excess inflation they want to generate. And that's the place where we'll probably be a bit more concerned about the inflation point going forward. Should that come sooner, and should that challenge central banks sooner in 2021, that will pose a risk for investors, but we think probably back-ended rather than early stage risk going into the new year. So on slide 15, if we just summarize some of the key points for 2021, the global economy relapse we don't believe is on the cards, recovery is on the cards, and the prospect actually for an upside surprise. So maybe instead of 5% global growth, as much as 6% global growth if we get this pandemic vaccine deployed. We want to focus on the equity front going forward. Again, earnings growth, less focus on valuations, as the earnings picture should address the valuation concerns. And then we want a barbell between the transformational opportunities that have been very successful for 2020, and we want to add quality cyclical positions in 2021 from here. On the fixed income and the foreign exchange side, you want to pair those two to really focus on moderate types of income returns generated from fixed income in 2021, with a focus really looking far afield outside of your home country, especially in emerging markets and especially in China for more income opportunities going forward. So I'm going to stop there. I'm going to hand it back to Nik for a broader discussion.
Thank you, Norman. Questions coming in. We've got 40 minutes left. I'm intrigued initially, and please keep those questions coming in the comments if you don't want to ask a question, because I can still put them to Norman. First of all, I'm intrigued, as I'm sure a lot of people are, why you've titled it A Brave New World, remembering Aldous Huxley's celebrated novel.
Yes, look, I think in a lot of ways, there's two aspects that are relevant to the title. One, we do think the transformation that is taking place in the global economy post-pandemic is quite remarkable. Whether this shift from offline to online, this acceleration in the penetration of new technologies, very similarly like what we've seen in the novel. We think all of these themes are going to be quite key to how we understand this new world that lies ahead of us.
How brave do people have to be? What's your definition of brave? Surely brave is also about risk-taking and seeing a broader way forward.
Yes, look, we do think you have to be a bit brave, or maybe put a different way, as you point out. One needs to be much more active in the risk management than perhaps in the past. And the simple reason for that is interest rates are at zero. In the past, you would have seen a balanced portfolio. If you held some government bonds, you held some bonds. If the stock market declined by 10%, your bonds would go up anywhere between 3 or 4% to offset that. Today, we've seen this in Europe and we've seen this in the United States now. Markets go down 10%, your bonds, if you're lucky, they do nothing. And in some cases, they will go down as well. And so this issue of brave really focuses on the importance of risk management in this new world.
It seems to me what you're saying is people need to have a much broader mindset about the new realities they're facing, the kind of realities we've all had to face for the last 10 months epidemiologically. But there are new realities which could be to everyone's advantage. But I'm interested, you also use the phrase, we have to avoid potholes on the road to the future.
Yes, look, I think the new reality is the right way of thinking about it. I think the ways we invested, the ways we made money in past decades, in a lot of senses, aren't going to be the same ways that we make money going ahead. In terms of potholes, when we look at the last decade, if we're honest about it, when we've encountered potholes, whether they were things like the European sovereign crisis or the Brexit shock, central banks came to the rescue to stabilize things and avoid these potholes from getting too big. We think central banks are largely out of ammunition. And as we're seeing right now, whether it's in Europe or the UK or the United States, fiscal authorities don't have the same reactivity nor the same commitment as central banks. And so the risk that you're going to run into not only potholes, but potential deeper potholes does exist. And that's different than we've seen really over the past decade.
What I'm really getting at, I think, Norman, is when in chapter 9 you say staying active in risk management, it's also about being far more broad-minded about what the new realities are out there, not just being active, but you've got to have your senses out in a different way.
That's right. I think if we look at how we invested not only over the last decade, but even going back further, realistically, the world was in a US-centric world, whether that's US demand, whether that's US monetary policy, whether that's with regards to the dollar. As we go forward, we're seeing monetary policy diverge, fiscal policy diverge, local interests diverge from global interests. And so that's going to create not only risks, but as we're seeing opportunities around the world that are very specific to more local policies. And so investors are going to have to be much more aware of what's going on outside of the United States, outside of their home market, so they can navigate those risks and really capitalize on those opportunities. And we think China is a great example of that.
Now, one of the things which we've talked about in recent days, since we've been waiting for this and preparing for this, is you were talking about 5 years ago. I'm talking about geopolitics here. That really 4 or 5 years ago, you weren't thinking about geopolitics. Now that has to be central, and I'm picking up questions already. What happens when China invades Taiwan is one question. What happens when a joint attack on Iran nuclear facilities by Israel-Saudi occurs, or a second or third virus occurs? In other words, thinking more broadly, I'm using that word again, but you were making that point that probably not enough was being considered on the geopolitical front.
Yes, look, I think all of those issues, so the China-Taiwan dynamic, the Iran dynamic, or even another pandemic that comes, again, from an investment perspective, bonds are not going to help you in that arena. And so that's why one of the reasons when we look at our risk management approach, it has to be multi-pronged. If you go back 5-10 years ago in traditional ultra high net worth portfolios, it would be very unusual for us to be using futures and option strategies. Whereas in the last 12 months, that's been very key for us in terms of navigating the risk over the past year. Alternative investments, which have been avoided since 2008, now start coming into play, not only for some of these asymmetric risks, but also because some of these longer term themes do involve a lot of risk and a lot of volatility. And these long short strategies help to mitigate some of that and allow investors to stay involved and engaged during periods of volatility in some of those themes. So I think how we invest is as important as what we invest in as we look over the next decade or so.
I'm now going to questions which we're getting a lot of, so we don't want to back end them, we want to actually front end them. Let me pick up on inflation, where you said, it could move. But one of the things you talk about in the investment outlook is actually inflation will be a good sign that actually the economy is picking up. And there's one question here, what about the inflation prospects? What is the impact for bonds investors?
So the inflation prospects, the key aspect of inflation, I think central banks want to see, honestly, is wage inflation. They're not so concerned about kind of what you're paying for in the grocery store, et cetera. But when we start to see wage inflation, then they will know that they are getting traction on their ultimate objective in terms of the labor market from here. So what does it mean for bond investors? Traditionally, that would mean that's quite bad for bond investors. Yield curves will steepen, bond yields will rise to the detriment of bond investors. We believe because of the amount of leverage in the system, it is unlikely that central banks allow interest rates to rise across the yield curve very meaningfully from here, because it would spur a default cycle, to be honest, that they would like to avoid. And so the way to think about this is very similar to post-war United States, where effectively the central banks control the yield curve, or Japan. We expect that as inflation starts to pick up, central banks will look to contain the yield curve movement, keep interest rates negative on an inflation-adjusted basis, and help contain the damage to bond portfolios. But for bond investors, it does mean that you're asymmetric in terms of your risk. You're only going to get a coupon, and if it doesn't work out for you, you do have a lot of risk. And that's why we think, for example, long-short credit funds in this environment make a lot of sense.
But are you ultimately saying that inflation would be good, particularly if there's a rapid uptick next year, simply because prices will start rising? There'll be much more economic dynamism, even if inflation begins to approach 2%.
Yeah, look, we think inflation has to be a part of the solution. The way to think about it is, with the amount of debt in the world, there's really only two ways to resolve it. Either one, you default on it, which nobody wants to do, or two, you inflate your way out of it. And what does that mean? That means inflation goes up, that means revenue goes up for companies, that means they get more revenue to pay down the debt. And we think that is the route that central banks and governments in general are trying to pursue to address this global debt problem. So I think it speaks to the idea the pandemic is one issue, the amount of debt in the world is another issue, and inflation helps to solve that.
Overall, do you have confidence in governments, the way they're handling it? Here in the United Kingdom, we're going to have the Chancellor of the Exchequer giving his State of the Economy announcements with indications, and there's been a lot of pressure. Don't turn on the locks too quickly. Do you think governments have now gripped the scale of what is happening, and particularly with Janet Yellen coming in as Treasury Secretary, we assume from January in the US, that there's going to be a significant additional competence in governments to handle this in the way that's necessary?
The way I would characterize it, I think civil servants understand what needs to be done. I think there is a question whether politicians have the wherewithal to be committed to what is required. And I think we're seeing that already in the United States. We're seeing that in the EU. So this first round of stimulus, I think, will be is likely. But as we move into recovery, will they be committed to, if you like, finish the project? And that is, at this point, uncertain.
Yeah, that's central to all our Thinking the Unthinkable work, even well before the difference between political ability to handle this, but also public servants and those serving them in the executive and the way they can handle it. Now, look, a lot of questions coming in, Norman. Let's go to currencies. Your thoughts on QE version 2 due to COVID and its effect on inflation and weakening of Western currencies. There's another question. What's your view on currencies like the dollar, the pound, the US against the Swiss franc and so on?
Yeah, so if we speak to the currency, I'll start with the US dollar, largely because most people around the world borrow in some form of US dollar. The dollar must weaken in this environment for this debt to be able to be repaid. And if you think about, if you're an emerging market, you borrowed in dollar, if your currency is weakening against the dollar, it's very hard to repay. And so that's why what we've seen in the past is in recovery, the dollar tends to weaken. It allows these mismatched borrowers to pay back much more easily. So we do think there is a dollar bear market ahead and continuing in 2021. Going forward from here, we think we're in the early stages of that. That said, we think the dollar strengthens, let's call it selectively amongst currencies. We think euro dollar probably moves into the low to mid 120s fairly easily. We talked about the renminbi, which we think there is some secular strength. We think Swiss franc, Japanese yen strengthen, but you need to be much more selective in some of the emerging currencies from here going forward. And so we think the QE story is part of the story in terms of inflation differential and interest rate differential, and we think we're still in the early stages of the dollar weakening story.
Now, Norman, I'm trying to weave a logical track through a lot of questions coming in, so bear with me if we jump around a little bit, but I'm trying to pick up a thread or three here. Is the Brave New World, which you write about and is the title of the publication, a multipolar or a non-polar one, since the dominance of the US is no longer the case? Is that still the case under Biden?
It is still the case under Biden. Look, I think if we're honest about it, I think the rest of the world is relieved that Donald Trump doesn't have a second term, but at the same time, to use Angela Merkel's words, I'm not sure they're entirely comfortable that the US is back to a reliable partner. So they must, if you like, chart their own path. I think the real question as we look forward is this a bipolar world or a tripolar world? So clearly China is charting its own path, separate from the United States in many ways. I think the question for Europe is, does Europe create another pole, if you like, on the continent separate from the United States, or does it ally with one of the two poles? I think that is yet to be decided. But we do think the multipolar world is more likely going forward than the unipolar world that we had in the past.
Could I put it to you, is there a danger of old think talking about polars in all of this, given the way the dynamics are changing in so many different ways, both economically and politically?
I think there is that risk, but I think one of the challenges, if we just look at sheer size of economic heft, if we look at technology, access to technology, if we look at things like access to the vaccine, it's not a surprise, if you like, US and Europe, they're accessing the vaccine from most of the same producers, whereas what we're seeing in the emerging world, China is providing the vaccine, Russia is providing the vaccine to many economies. And you are seeing this polarization move. And so the idea of a non-polar world, I think, probably takes it a step too far, especially in the emerging world, as I think they do, and they will need an anchor going forward.
Now, we've got several questions on commodities, so some of it is quite specific, but let me offer you three of them now. What is your view of copper and how best to invest in it, brackets, if we should? Secondly, I'd like to hear your position on gold and other commodities for 2021. Thirdly, what is your view on platinum, almost at a 10-year low, but has gained of late? Should we be also picking up with the pickup in the car industry, for example? Will that act as a multiplier and an accelerator? All three of them.
So let's start with copper. I think copper is a really interesting story because it has cyclical dynamics involved, has supply-demand dynamics involved, and then has secular dynamics involved. Copper, we like to use copper as if you like, an early signal to what's happening in the global economy, and copper is telling us the global economy is on a recovery path. So that's quite good. The very nice thing about the broader commodities complex is realistically, they've been in a bear market for, roughly speaking, about a decade. And what that's meant is you've had underinvestment in supply. And it's very hard to put on supply rapidly in this segment. So even though demand is coming up with cyclical recovery, you won't have supply come up. And so generally speaking, you have this supply-demand mismatch that will lead to higher prices. With copper in particular, we think this is the same for something like palladium. We think there are some secular drivers in play in those two as well. And I'll throw in silver on top of that. The greening of the global economy is going to require these metals, full stop. And so this secular investment, the secular demand for a lot of these green technologies will add to the cyclical demand that we're seeing come into play. Speaking to the issue of palladium, yes, they should benefit from the cyclical aspects of the return of cars. However, the kinds of cars people are driving are different than what they used to be. Platinum, in particular, is required for diesel engines. Europe, probably in 5 or 10 years, will not sell diesel cars. They will shift to hydrogen or electric from here. China is already moving very rapidly from that perspective. And then when you compound that with a less attractive supply-demand imbalance, platinum is not something we're particularly excited about from here. We would prefer a silver or a palladium to a platinum currently.
Thanks, Norman. Central banks and governments. Again, I'm zigzagging a little bit, but forgive me because new questions and comments are coming in. Some of them repeat, so I'm not asking them again. But building on what you've already said, your thoughts on the impact on governments of printing money in unprecedented quantities. I guess I will add to that question, when does the day of reckoning come and when should it come? Secondly, what do you think of the inflation-linked bonds, bond funds? What are your reservations for fixed income investors?
Sure. So if we think about going back to 2008, when we first experimented from quantitative easing in the United States, the Japanese had done this before. This was viewed as a non-traditional and exceptional event. And here we are 10 years later. These are now very traditional tools at central bank disposal used around the world in many countries. So the impact on central banks and governments, I think they all think they have a new tool in their toolkit going forward. I suspect as economies move to digital currencies, it will actually increase the effectiveness of this tool going forward. And so I would not think that quantitative easing or these exceptional tools that they've deployed will go away anytime soon in terms of policymakers' toolkits. The second question you asked, Nick, was?
About central government. What about the, forgive me.
Oh, inflation-linked bonds.
Inflation-linked bonds and bond funds. What are your reservations for fixed income investors?
Yeah, so inflation-linked bonds, and I'm going to focus on the US, and I can come back to you separately on other regions. I think technically we like inflation-linked bonds given our outlook on inflation. Our only concern tactically, if you like, is what inflation-linked bonds are telling you about the economy going forward. So if you look at inflation in the United States over the last 5 years or so, it's averaged about 1.8%. Inflation-linked bonds today, you're essentially paying for 1.8% inflation. And so we're not getting paid asymmetrically for that risk at this point. If the market's underpriced inflation, let's say 1.5, 1.6% in the US, that's a place where we'd probably be a little bit more interested in inflation linkers from here. In terms of bond funds, we do want to be relatively careful on bond funds, especially in the higher quality types of bond funds. And that's because one of the stories that we are focusing on in bonds is, again, looking through volatility and holding to maturity so that we can get the extra coupon. One of the problems with most bond funds is they don't mature. And so if we do have a situation where interest rates are rising steadily going forward, that just means in a bond fund, you are going to get a permanent headwind to your total return. And so it's not a very good buy and hold opportunity unless it's a fixed maturity opportunity in the bond fund from here. So we prefer fixed maturity or single line bonds that we're holding to maturity going forward in this low yielding environment.
Okay, we've got 10 minutes to run, Norman, and I've still got a lot of comments, so I'm going to keep pushing the pace. Let me bring together 2 or 3 about markets. Here's one. In a balanced portfolio where traditional fixed income no longer plays a balancing role, which other asset class could take over the role? Offshore relative value, multi-strategy hedge funds, or infrastructure global funds? Are they reliable candidates? And I've got a couple more as well, but that's quite a loaded question.
So the answer, I think, is going to be multi-pronged. If you think about the role fixed income in a balanced portfolio has played historically, it's really played 2 roles. The first role, and I'm going to use government bonds as the surrogate, has been, if you like, protection plus real preservation. So historically, you've been able to buy a government bond, it pays you a coupon, something near inflation, and then you get your money back at the end. And oh, by the way, when equity markets go down, government bonds go up. And so that's very good. If we look at that protection component, we don't see that many assets that really provide that for us in portfolios. And so what we've been doing really over the last 12, 18 months have been turning to options markets, structured product solutions to try and replicate what we call this asymmetry within portfolios from here. The second part of the equation for bonds is this income, this carry component. So how do I get income in portfolios? And again, we do think there's a couple different ways to do that. If you want to stay in the bond space, it is moving into places like China local currency government debt. It is moving into emerging market debt. We think the European cocoa space makes quite a lot of sense from here, and then being very selective in the high yield credit arena from here. But as you rightly point out, that may not be enough to get you to where you want to go. So we do think, if you like, things like distressed debt, infrastructure, insurance link debt, we think those type of things can be used in a portfolio construction to continue to enhance yield, to diversify your portfolio to achieve the objective at minimum risk. So it's a much more complicated construction in replacing a bond portfolio, given the size of the allocations that have historically been in place. And so it's going to require a multi-pronged approach.
And these next 2 of the 3 really pick up on that. On the equity side, can you elaborate on quality cyclical positions? And also, which would be the ideal asset allocation for an aggressive portfolio broken down by assets and countries for, say, the next couple of years?
So in terms of quality cyclicals, I think there's a couple of different things that we're looking at. If we stretch time horizons and think about what we've talked about in terms of green and the cyclical recovery, we think the global mining sector and high quality industrial companies make a lot of sense for investors to be looking at from here. If we look a bit more tactically in the reopening of the economy with the vaccine coming, we want to stay in the quality segments, but some of the quality travel areas make a lot of sense for us on the quality cyclical front. In terms of the geographic allocation, again, going back to your point about multipolar, it was not a wrong approach, if you like, for the last decade or even longer to say, okay, I'm going to hold American equities and then I'm going to go away. Nothing really going on in Europe or Japan, etc. We do think a couple dynamics have changed that suggest you want to, again, take this broader brush. There are still great, especially growth opportunities in the United States. But one of the things that falls away, especially for non-US investors, is the dollar is no longer at your back. The dollar is going to weaken, so you're going to buy US equities. Unless you're hedging it, you're going to get a headwind from a weaker currency. On the flip side, we do think the cyclical global recovery and the spending that you're going to see in Europe and China going forward on things like green means that you're going to have an industrial cycle around the world, and that tends to be good for really countries like emerging markets, Europe and Japan. And so we want to spend more time looking for opportunities there in addition to some of these more long cycle growth stories that we find in the United States.
All right, Norm, we've got about 3 minutes left before I go hand back to Michaël. And picking up on geopolitics, we've got two questions about Asia. Let me ask them individually. Be quite brief if you can. Little mention of India's impact to markets. The pandemic has stalled growth, but Modi talks about the strong growth in 2021. So what's your view for demand for commodities and growth in industry and businesses within India and the investor opportunity?
We think the India story is actually quite good. The valuation story isn't as attractive as we find in other locations. But I think since you introduced this as a geopolitical angle, if you like, so China clearly is going to, if you like, go its own way. They're going to try and create their own ecosystem going forward. I think the US and to a certain extent Europe as well, they will also need an anchor in Asia in terms of demand. And you've already seen these economies reaching out to India. So I suspect that the path ahead for India will be to try and increase ties with economies in the US and perhaps in Europe. And I think perhaps in that regard, it's not a surprise that India has not signed on to the regional trade deal with China at its center, and has instead said, no, we're going to go with bilateral agreements instead. So it highlights that India is charting its own path in terms of how it wants to go forward. I think that makes a lot of sense for India looking ahead.
All right. And finally, on China, quickly again, if you can, will the pandemic risk be a permanent driver of risk management? Is China addressing this issue to avoid a new pandemic, taking health and prevention measures like Western countries, for example, on wet markets? Now, probably that's something as well we should be talking to the World Health Organization about, but do you have a view on that quickly?
Yeah, so it's just quickly on the pandemic, obviously human tragedy, but I think we must acknowledge that what we've seen out of Pfizer and Moderna in particular in using what's called mRNA technology to develop a vaccine in really under a year is an important shift in terms of how we develop treatments. We have never seen a vaccine like this developed in such a short period of time. And so as we go forward, look, I'm not a doctor, but I suspect this really changes the landscape in terms of how we address future pandemics and future health issues going forward. So perhaps if we're lucky, it'll be another 100 years before we see anything like this again.
If we're lucky. And final thought, one question here, do you envisage further rise in the oil price and accordingly in oil stocks in 2021, or are they really becoming legacy?
Look, on a secular basis, they are becoming legacy, but again, cyclically, they're going to have that bid come into play just because legacy does not happen overnight. So people are they're going to have to power the trains, they're going to have to, they go into plastics, et cetera. So as that demand comes back, there will be demand. And so we do think oil prices can be well bid. We think the Saudis in particular have little interest of allowing the Americans back into play. And so moves much above $50, I suspect the Saudis will start turning on the tap to keep the pressure on American shale interests.
Mm-hmm. Well, Norman, in the last 40 minutes, we've done 22 questions in about 40 minutes. So we've got through an enormous amount. And I hope there are many of your clients out there who feel comfortable that they've had great answers from you. So thank you very much indeed, particularly for the intensity with which you were able to answer them. Let's go back to Michaël now. Michaël, perhaps you could, in your final moments, just reflect on what clients should be doing now after attending this session, what would you expect at UBP?
First of all, thanks a lot for the quality of the questions and how we tackle this investment outlook. You understood that we are tackling 2021 with a positive and a constructive mindset, and of course the vaccines and the velocity of the research to elaborate these vaccines is a trigger for this switch from what we had in 2020, I mean a very selective area, a very tough area in terms of macro environment, to something more constructive and with these expectations of a sharp recovery. The V shape is probably what we could have on the macro side, and overall it's a very good news for the overall activity in the world.
And your thoughts for clients going forward?
Clearly, they have to remain close to their bankers in order to have additional information and more details on the research we have implemented at UBP. You can find the brochures, the details, and all documents on our website, www.ubp.com. And don't hesitate again to be close to your bankers in order to have all this information.
Thank you, Michaël, and thank you to Norman as well. We've been through an intense 1 hour, literally 60 minutes. We've achieved an enormous amount. Can I mention the UBP newsletter, which will always be catching up regularly on the kind of things that Norman and Michaël have been talking about on a regular basis. And obviously, one has to be pretty agile and nimble, given the way the world is moving at the moment. And as Michaël says, contact your relationship manager at any point. Thank you to UBP. Thanks for inviting me to help you, and all those behind the scenes who've made this possible, the technical crew who've conceived it, made sure it worked, and worked fantastically smoothly. So to all of you, thank you very much indeed for joining us, and from Michaël and Norman and myself, Nik Gowing, thank you.